The Mediterranean Sea, 1996. A 167-foot yacht, once owned by fashion icon Coco Chanel, is battling towering waves. Aboard, its new owner, Jordan Belfort, high on drugs, insists they sail directly into the storm. Hours later, the vessel sinks, forcing a dramatic rescue. This wasn't just a rich man's reckless stunt. It was a perfect, albeit literal, metaphor for the dizzying rise and catastrophic fall of the man known as the Wolf of Wall Street. Before the yachts and the drugs, before the infamous title of the Wolf of Wall Street, Jordan Belfort was a high school dropout fueled by an insatiable hunger for wealth. His first taste of entrepreneurial success came from selling Italian ice from a cooler on a beach, netting him a respectable $20,000. It was a small-time hustle, but it showed him the power of sales and the thrill of making money. He briefly entered the legitimate world of finance as a trainee stockbroker at LF Rothschild in 1987, only to be laid off after the infamous Black Monday crash. For many, it was a devastating setback. For Belfort, it was a brutal, yet invaluable lesson in the fragility of markets and how to exploit the chaos that followed. Undeterred by the crash, Belfort saw a different kind of opportunity, not in legitimate finance, but in the less regulated, high-stakes corners of the financial world. In 1989, alongside his ambitious partner Danny Porush, he co-founded Stratton Oakmont. It started small, operating out of a nondescript office, but Belfort possessed an almost hypnotic gift for selling and motivating others. He didn't teach finance. He taught a ruthless, straight-line system, a high-pressure sales technique designed to break down any client resistance. No was not an option. He cultivated a culture of aggressive, unapologetic greed, attracting a legion of young, hungry brokers who idolized his lavish lifestyle. Within just a few years, Stratton Oakmont exploded. At its peak, it employed over 1,000 brokers, managing an astonishing $1 billion in client funds. But behind this dazzling facade, a far darker mechanism was at play. What was the true, destructive engine powering this empire? The true engine of Stratton Oakmont's astronomical profits and the source of its deep depravity was a sophisticated yet brutally simple scheme known as pump and dump. Here's how it worked. Jordan Belfort and his inner circle would secretly acquire vast quantities of cheap, often worthless, penny stocks, shares in tiny, obscure companies with little to no real value. Think of it like buying shares in a company that makes unproven gadgets or has no actual product. Once they owned a significant chunk, Belfort's army of brokers, masters of manipulation, would spring into action. They'd relentlessly cold call ordinary people, doctors, teachers, retirees, small business owners, using aggressive tactics and outright lies. They'd spin tales of imminent breakthroughs and guaranteed riches, creating artificial demand for these hot stocks. This was the pump, driving the stock price higher and higher, often by hundreds of percentage points, based on nothing but hype and deceit. Once the price had been ridiculously inflated, Belfort and his cronies would then dump their own shares, selling them off for astronomical, ill-gotten profits. The moment they sold, the artificial demand evaporated. The stock price would plummet, and unsuspecting investors would be left holding worthless paper. Their life savings vanished. This elaborate fraud ultimately cheated thousands of people, out of approximately $200 million. Grew Wilder, notorious for spectacles like midget tossing, employees bringing in sex workers, and one infamous incident where a woman was paid $5,000 to shave her head at an office party. The firm's excessive lifestyle and dubious practices began to attract unwanted attention. As early as 1992, the Securities Exchange Commission, the SEC, initiated its first major enforcement action against Stratton Oakmont. The regulators were seeing the red flags, the unusual trading patterns, the aggressive sales. By 1994, the firm was forced to pay a substantial $2.5 million in a civil securities fraud case. Even more critically, Jordan Belfort himself was explicitly banned from running a brokerage firm. Yet astonishingly, the fraud continued. The firm simply found ways to circumvent the rules, operating deeper in the shadows, pushing the boundaries even further. It was a clear sign that the wolf felt untouchable, daring regulators to catch him. But how long could such blatant disregard for the law truly last? The relentless game of cat and mouse couldn't last forever. The constant pressure from regulators, the mounting evidence of systematic fraud, and the sheer scale of the deception finally led to the inevitable. In December 1996, the National Association of Securities Dealers, the NASD, took the decisive final step. They officially expelled Stratton Oakmont. This wasn't just a fine or a warning, it was a death blow. The firm was completely shut down. Its reign of financial terror abruptly ended. But while the brokerage house crumbled, the legal battle for Jordan Belfort was just beginning. It would take 3 more years before he was finally brought to account. In 1999, Belfort was indicted for securities fraud and money laundering. Facing overwhelming evidence and the prospect of a lengthy sentence, he pleaded guilty and agreed to cooperate with authorities, providing crucial information that helped convict his associates. The architect of the pump and dump empire was finally caught. But the question remained, what about the thousands of lives he had shattered? The collapse of Stratton Oakmont left a devastating ripple effect that stretched across America. Jordan Belfort had defrauded thousands of ordinary people, not just institutions, out of approximately $200 million. These were families, small business owners, and retirees who had trusted brokers with their life savings, only to see their financial futures evaporate. Take Ken Miner, a real estate appraiser from California, who, desperate for a good investment, used a home equity line of credit to invest with Stratton Oakmont. He lost so much that years later, he still hadn't repaid that loan, a constant, painful reminder of his trust misplaced. Peter Springsteen, an architect just starting his business in Connecticut, answered a cold call from a Stratton broker and lost about half his entire life savings. Perhaps most heartbreaking was the story of Dr. Alfred E. Vitt, a retired dentist who lost a staggering $250,000. Brokers would initially sell him legitimate stocks to build trust. Then, once he was hooked, they would become downright hostile when he tried to refuse their manipulated penny stocks. In 2003, after his cooperation, Belfort was sentenced to 4 years in prison and ordered to pay $110.4 million in restitution to his victims. He ultimately served just 22 months, sharing a cell with none other than comedian Tommy Chong, who famously encouraged him to write his memoirs. But here's the most shocking and enduring part of this saga. As of the mid-2020s, Jordan Belfort still owes an estimated $97 million to $100 million to the very people he defrauded. The Wolf of Wall Street walked free, became a celebrity, but his victims are still paying the price for his unbridled greed. Jordan Belfort's story, immortalized in his best-selling memoir and the blockbuster film, has become more than just a tale of fraud. It's a chilling cautionary tale of unchecked ambition, toxic excess, and the profound human cost of financial manipulation. It's a stark reminder of how easily trust can be exploited, and how quickly the promise of quick riches can turn into devastating financial ruin for ordinary people. The Wolf of Wall Street may have served his abbreviated time, and now travels the world as a motivational speaker. But for the thousands of individuals whose lives he shattered, the echo of his fraud continues to resonate. The question remains, when the system fails to protect its most vulnerable, and justice remains incomplete, who truly pays the ultimate price for the real wolf's insatiable feast?